This one simple concept of PDRA helped me go from being unprofitable to making thousands of dollars in payouts. So today I'm going to break down how does the PDRAs work in ICT concepts and how you can make thousands and thousands of dollars by understanding the concept of PDRA, and you can easily be profitable. So just don't skip this video, watch the video till the end, and I'm going to break it down for you. So the Discord link of my server is in the description. Join my Discord, and also if you haven't subscribed my channel yet, go and subscribe the button. So let's begin. So what is PDRA? PDRA is an arrangement of ICT key levels in premium and discount zones. As you know what is premium and discounts, we draw the premium and discount zones in between highs and lows. And in this between highs and lows, we have many key levels that we say as PDRAs. And these PDRAs are used to enter the trade as well as find the buyers. And these are the PDRAs are extremely important because even in higher time frame to lower time frame, these PDRAs will play a key level to determine the bias and even determine the entry and even determine your 50%, I mean your partials at 50% and all the things. So next. So these are the important list of PDRAs that we have to use in ICT concepts. The first PDRA is ICT liquidity highs and lows. Second one is order block. Third is breaker block. Fourth is fair value gap. Fifth is rejection block. And the last one, inverse fair value gap. So let's go and dive deep into the PDRAs. The first one, ICT liquidity highs and lows. These highs and lows, especially our swing highs and lows, are just more than the price extremes because, as you know, the stop losses are placed on these swing highs and lows. So, if you are able to mark correctly the swing highs and lows, then you can make huge RR out of every trade because these are the stop losses where you can enter and where you can book huge profits with a small SL. So these levels attract institutional attention, making them powerful zones for potential reversals or continuations in price. So what I mean by liquidity highs and lows is this swing highs and lows are just not swing highs and lows because we have to check the swing highs and lows on 15 minutes, 4 hours, daily and weekly. And when these swing highs and lows are compared, we can see that it instantly gives reaction when it is checked on higher time frame. So it's liquidity high. So liquidity high is a recent swing high where sell stops are resting, and liquidity low is a swing low where buy stops are placed. So price often grabs this level before reversing. It's how smart money enters. I will show you a few examples now, so where you can get the idea how this liquidity swing highs and lows works. See, now you can see here the liquidity low, the stop losses were placed just below this low. So when price just swept this low and took out all the stop losses of the buyers of dumb money, the smart money bought at this low and it instantly reversed. So are able to mark out this liquidity highs and lows very clearly, then you can be instantly profitable. I can say that instantly, but it is going to take a while to perfectly identify this liquidity highs and lows. And here you can see the buy side, sell side liquidity, and when this liquidity was grabbed, the price instantly reversed, and when you can see this fair value gap that was created, the price retraced back to this fair value gap and then dumped down. So other than this, there are others important highs and lows that we can see here: daily highs and lows, and weekly highs and lows, monthly highs and lows, and highs and lows of high impact moves like CPI, NFP, and FOMC. So these highs and lows are very important. The price very well gives reaction to these highs and lows and often reverses after just sweeping out the liquidity. So let's say these low is a FOMC or NFP low, and price will just sweep all the SLs here and then reverse back. Mean to go. So let's see next PDRA. This is very important PDRA that you will see. It is fractal over any time frame from 5 minutes, 1 minute, or up to the daily time frame. So an order block is the last opposing candle before a significant market move. It marks the footprint of institutional buying or selling, often serving as a key zone for price to return to before continuing in the same direction. So basically, order block is when liquidity of the previous lows are swept, a huge or let's say a thick candle is formed, thick red candle is formed, and this red candle is called an order block. I will show you a few examples so that you can get an idea. So here you can see price took out the liquidity from the previous swing low, and this thick black candle, or you can say red candle, was formed, and this red candle had all the limit orders stacked up. So when the price came back to this order block, it instantly jumped and gave the reaction. And here you can see it was a bearish order block. When the price came to this bearish order block, it instantly reversed down and gave the reaction. So the bearish order block is often the when the swing high is swept and there is a thick green candle that is formed, and the price will often have a retracement up to this order block. And as you can see, the price retraced up to this order block and created a very low resistance liquidity, and this low resistance liquidity will be swept later on, and this price is likely to reach up to this low. So let's move on to the next PDRA. So this is breakup block. Breakup block is very important PDRA because if the price doesn't give reaction to the order block, the breakup block is most likely to get a reaction. So breakup block is a failed order block that price later breaks through, or we can say last pullback before the trend ends. Once validated, it flips its role. What was support becomes resistance and vice versa. So I'm going to explain you these on the charts so you can get a better idea. So here you can see this swing high was swept uh, by this swing high, and the last pullback, you can see the last pullback before the swing high where the liquidity was swept is considered to be an order block. So here this is a bearish order block. So when this bearish order block, sorry, I mean bearish breaker block. So when this bearish breaker block was formed, it when the price uh, I mean, when there was a market structure shift and when the price retraced back, it gave instantly reaction to this bearish breaker block, and the price continued the downtrend. Similarly, this was the last pullback before moving down. So, breaker block is basically the last pullback before the uh, liquidity sweep. Here in bearish breaker block, this was the last pullback before the liquidity, and in the bullish breaker block, this was the last pullback where the price swept the liquidity, and so this price will often give reaction to this bullish breaker block. As you can see, the price didn't reach up to this block, but it gave reaction to this breaker block. So it is very likely that if the price gives reaction to the breaker block, then it won't reach up to the order block. So this is how you identify a breaker block. Price often gives reaction to the breaker block if there is no reaction up to the order block. So now next is the fair value gap. As you know, fair value gap is just an imbalance that is left behind during a strong move. You can say buy move or sell move. Gap is seen between three candles, and smart money often revisits these areas to rebalance price before continuing the trend. So now you will see the examples. This is a bearish fair value gap. So price is just going to retrace back up to this fair value gap and then dump down. So this is a here is a bullish fair value gap, and price will retrace back up to this bullish fair value gap and then again continue the higher trend. This is very simple. I guess I don't need to explain much in fair value gaps. So the next is rejection block. A rejection block forms when price attempts to break a support resistance but sharply reverses, leaving behind a candle or zone where institutions likely rejected continuation. It often becomes a powerful lever for future reactions. So a rejection block is quite similar to the order block because there is a liquidity swept and rejection block too. The only difference is a rejection block has a very higher wick. I mean, the wick of the rejection block is large compared to the other candles, and that's why the price doesn't give reaction to the body of the candle, but it gives reaction to the wick. As you can see here, the wick of this candle is very long, so price didn't give reaction to the body, but it gave reaction to the 50% of the wick and instantly bounced back. So this is how you define the rejection block. The rejection block is just the wick of the candle which is likely to get a reaction when the price retraces back into the store. Inverse favorability gap. So this is the last one. Inverse favorability IFBG is found when price sweeps liquidity and displaces aggressively, leaving behind a strong imbalance. It marks where smart money entered after a liquidity grab, making it a powerful zone for future reactions and continuation setups. So now you will see what is IFBG. Let's say price grabbed all the liquidity before the swing highs, and there's a change in state of delivery here. So as you can see, this is an IFPG. So the IFPG, when there is a change in state of delivery or whatever you say, market structure shift, it is very likely that price will retrace back up to this IFPG, and then you can get your entry at the IFPG, and the price will retrace back to its original direction. So here you can see a bullish IFPG. There is a change in state of delivery or market structure shift. Uh, and after that price will retrace back up to this IFPG and then continue higher, and the vice versa happens in the bearish IFPG. There's a change in state of delivery, and the price is very likely to come up to this bearish IFPG, and then it may continue down. So that's all, I guess. If you have any queries or doubts or any upcoming suggestions for next videos, please write down in the comment section, and also uh, please hit the subscribe button if this was helpful for you.